Have you ever wondered how financial market works? Bonds, stocks, forex, commodities. This sounds might a little bit complicated, but don't worry. In this video, I will break down financial market in a simple and easy understand way. And if you're new here, I'm business analyst, I'm working in investment banking, and I'm also MBA and CQF qualified. So what are the financial markets? Financial markets are the platform where people can buy and sell financial assets like stocks, currencies, bonds, commodities. Those markets play a crucial role in the global economy by helping businesses and corporates to raise their capital and also allowing individuals to invest and grow their wealth. So let's look what are the types of the financial market. And firstly, I would like to discuss about stock market. The stock market is the place where the business sells shares to the investor by providing them opportunities to become an owner partially of their businesses. And this happens for many reasons. For example, companies might want to raise their capital, expand their business, or maybe to have more fundings in order to proceed with the research and development area. When you buy a stock of the company or the business as an investor, then automatically you own a small part of that business. And when the prices of the shares go up, then automatically you will benefit from the price appreciation and dividends. However, it's important to notice the prices also can fluctuate based on the economics factor, market condition, and of course company or business performance. Popular stock exchanges where those transactions occur would include New York Stock Exchange and Nasdaq. They would host thousands of publicly traded companies from various industries. In the bond market, investors lend money to the government and companies in exchange to the interest periodic payments, which also called coupon payment. This market serves as the crucial financial tools because of it allows government to raise capital to fund their infrastructure project, for example, building more schools, invest to the roads, libraries, and also helping corporations to expand their operation without diluting ownership. There are so many types of the bonds. If you're looking from the government bonds perspectives, we can see an example of the US Treasury bonds. This is also considered one of the most safest investments because of their backing by the federal government. On the other hand, corporate bonds, which are issued by companies, usually they carry the higher interest rates because of the risk associated with their business financial health. For example, if investor decided to buy a US Treasury bond with its principal of $1,000, the maturity will be 10 years and also 3% of the interest rate. It means that every year he will be receiving $30 a year, and at the end of 10 years of its maturity, investor will receive in total $300 in the interest payments and also $1,000 of the initial investment. In comparison, corporate bonds might offer 6% of the interest payment, which means with the same amount of the investment of $1,000, investor will earn $60 per year or total $600 in the 10th year and the end of the maturity, including $1,000 of the initial investment. However, as I mentioned already before, corporate bonds, they usually have high risk of the investment because of their financial stability compared to the government bonds. And generally speaking, a lot of people, they choose bonds because of they provide predictive income and stability, and this is one of the most preferred choice of the investment, especially for the conservative people or maybe people who are close to their retirement or those who are also looking to balance their portfolios. Unlike stocks, which can be fluctuate, bonds offer steady return and very often are used to hedge against the market downturns. Let's talk now about the Forex market. The foreign exchange or Forex considered it's one of the largest financial market with the trillions of dollars traded on daily basis. This is where currencies are sold and bought, which are affecting international businesses, trade and travel. For example, if US tourists visit Europe and currently the exchange rate is $1 equivalent to 0.90 euro, which means that exchanging $1,000 in return will give them 900 euro. Similarly, businesses, when they trade or operate globally, they will have to convert currencies in order to complete transaction. For example, if Japanese company, they need to buy $50,000 worth of oil from US companies, and currently exchange rate is $1 equal to 110 Japanese yen. This means that they will have to exchange 5,500,000 Japanese yen in order to complete the transaction. There are so many factors that affect the fluctuation of the exchange rate, and some of them are supply and demand, economic conditions, and also political events, which are making Forex market essentially a dynamic part of the global economy. Let's move to the commodities market. This market deals with the goods like oil, gold, wheat, and again prices here will fluctuate based on the supply and demand. For example, if the global supply of oil decreases due to the geopolitical events, the oil prices can easily increase from $70 per barrel to $100. And similarly, if there were some jump in the supply of the wheat, then the prices can easily go from $5 per bushel to $3. Those fluctuations impact significantly industries, investors, and consumers globally. And last but not the least, so why are financial markets are so important? As we already touched base before, financial market allowed companies to raise the capital through stock offerings, issuing the bonds which will allow them to invest in new projects and innovations. Government bonds utilize financial market in order to issue the bonds to invest in the essential infrastructure project like hospital, roads, schools. And for the individuals, financial market provide them with the investment opportunities, such as investing in the stocks or bonds, which will help them to grow and raise their wealth. For example, if the investor decided to buy $10,000 worth of the stock with the 7% of the return annually, he will be able to make almost $20,000, which is almost double the amount of the initial investment that he made. Without those markets, business will struggle to secure more funding, governments would face financial constraints, and people will have less opportunities to build their wealth. And ultimately, this might slow the economic growth. So if you enjoyed this video, you might also like this one. And please don't forget to subscribe if you haven't yet. And thank you very much for watching me, and see you in the next video.